Next up is Ivo Mulder from UNEP FI. Yes. FI.
Good afternoon, everyone. Is it possible to get the slides up? If not, I can entertain you in a different way. Right, sure. All right, good afternoon, everyone. My name is Ivo Mulder. I work for UNEP Finance Initiative, the UN Environment Program, in a specific unit that works with banks, mostly global private banks, but also public banks, fund managers, institutional investors, and insurance companies. And our core objective is to mainstream environmental, social, and governance factors throughout the financial industry. We've incubated an organization that's quite well known, the UN-backed Principles for Responsible Investment. A colleague of mine did that, developed the insurance equivalent, the Principles of Sustainable Insurance. And what I'm going to talk to you about today is a specific focus on sovereign bonds. As the previous speaker alluded, at the moment investing in sovereign bonds means investing in business as usual. It wouldn't show any sort of move away from a carbon-intensive economy to a low-carbon economy that's also more equitable and where resources are used more efficiently. Why do bond markets matter? Not many of you may know, but corporate bond markets and sovereign bond markets together are about twice as big as global equity markets. In other words, the value of all companies, listed companies combined, is about half as big as the debt that those companies and also sovereigns are issuing together. At the moment, there's no integration whatsoever of environmental, social, and governance factors. In other words, investors investing in bonds don't or the companies don't receive any sort of signal that they need to change their practices one way or the other. Equity investors are, of course, focused on return enhancement, making sure you make more money, whereas bond investors are mostly interested in risk mitigation. And if we believe the fact that we move towards a more resource-constrained 21st century, where weather extremes, water scarcity, ecosystem degradation is increasingly having an impact on our global economy, then we should be interested to understand how these factors could be incorporated in bonds, because they effectively, thanks very much, because they effectively may actually affect the performance of this. Together with Global Footprint Network, we worked on a project called ERISK, Environmental Risk Integration in Sovereign Credit Risk, which is part of a project called the Natural Capital Declaration. And we worked in this case with these banks and investors to try to uncover how and where environmental factors are actually relevant. So why does this matter? In a nutshell, I think most of you know that through the Millennium Ecosystem Assessment, through the economics of ecosystems and biodiversity, and many other studies, we know that the ecosystem degradation is a fact globally, whether we focus on forests, coral reefs, or on other types of ecosystems. The cost to the economy is increasingly getting more sophisticated. So what you could say is that the science around ecosystem degradation is sound, but there's a very weak financial argument of why equity or bond investors should pay significant attention to it. You've heard about stranded assets. This is a slide from Carbon Tracker, which did a very interesting study on comparing listed reserves of, fossil fuel reserves of listed oil, gas, and coal companies with the so-called carbon budgets that we have available, which you see on the black column. If we would take their advice, it means that between 60 to 80% of already proven fossil fuel reserves of only the listed companies, I'm not even talking about the unlisted companies, the national oil, gas, and coal companies, only the listed ones they will probably not be able to burn 60 to 80% of their reserves. So there's really a big mismatch between bond ratings, valuation, and the build-up of environmental risk in capital markets. Sovereign bond markets are interesting for two ways. First of all, the amount of outstanding debt has mushroomed because of the financial crisis. Governments have borrowed heavily to power their own economy, and you see that in the last 10 years, the amount of outstanding debt by McKinsey's graphs there has increased by 23% as opposed to 3% in the 90s. Then another effect of the global financial crisis is that investors are required to hold more so-called safe assets on their books, which means move away from equity into debt with so-called good credit ratings. I'm not sure if you know, but Norway is one of the 4 remaining European countries with a AAA credit rating, and it will have it already had and will have a further effect on being able to borrow cheaply on capital markets, whereas Southern European countries have more difficulty. And this graph from S&P, or sorry, from The Economist is quite striking. The left column shows what the calculated default risk was according to the major rating agencies, and the right column revealed the actual default rate for the so-called subprime mortgage-backed securities, which is a difference of a factor of 100, which basically shows it's very difficult to measure risk. It's very difficult to measure risk the further away a financial product is from the underlying asset. And we also know the implications are huge, and that also concerns the environment again. So I would say these elements, the major increase in sovereign debt, the science around ecosystem degradation, the disconnect between ESG and financial analysis, as well as the fact that at the moment there's no integration whatsoever of environmental and social factors in bond markets, made us to believe that this is a very worthwhile project to look into. I won't go into the methodology, just jump straight to the conclusions, given that we have 10 minutes available, and I also want to hear your views, of course, on feedback that you may have on improving this project. So the conclusion that we had, because what is important is to move away from qualitative to quantitative analysis. How and where does this matter to bond markets in a very financially focused way, and what can investors and also rating agencies do themselves? So we looked, and you see that in the dark blue diagram, dark blue bars, we looked at the effect of the changes in commodity prices due to disruption of supply chains as a result of ecosystem degradation on trade-related GDP, and we found effects positive for Brazil because it's a net exporter, and negative for the 4 other countries that you see there of up to 0.5% on an annual basis for trade-related GDP, which is probably already significant enough to affect the country's credit rating for those 5 countries researched. What is more interesting is when we looked at the erosion of a country's own natural capital. As a country draws down its own natural capital, its fishing stocks, its forest resources, etc., you'll probably have to import more from other countries. And that, of course, will have an effect on the cost in your input and output of trade-related GDP. It's different for these 5 countries researched, of between -1% of a country's GDP to -4 in the case for Turkey. I would argue that the dark blue diagrams, the volatility of commodity markets are already probably priced into the government balances and the trade GDP. However, the other graphs, the light blue diagrams, looking at continuous erosion of a country's natural capital and the effect on trade-related GDP is currently not accounted for whatsoever. And this will definitely have an effect. If you look at credit default swaps, the CDS, as well as the credit ratings, what you see on the top, there's no correlation at present, making us very eager to work with the rating agencies and with the companies such as Markets that produce these CDS indices. And that's what we want to do in phase 2. So the core of this project is to see how we can make the current model that we have developed more robust, and also to integrate it directly and test it for a sovereign credit risk model. One of the reasons I was here in Norway is, of course, first to be here with you today, but also to see if the Norwegian Government Pension Fund, NBIM, is interested to participate in the second phase. The objective is to get started in Q1 of next year with 8 to 12 interested institutions. I've secured a few, and I'm in the process of trying to sort of complete this coalition with the ultimate aim of getting a clear definition and understanding of the materiality of natural resource risks, but ultimately to aim to mainstream this through sovereign credit ratings and by having investors factor in these directly in the valuation and selection of, in this case, sovereign bonds. And also an acceptance by the wider community, including the World Bank and IMF. I'm not a legal scholar, I'm an environmental economist working for the UN. It's an interesting audience I'm speaking to today, because besides Beate, I haven't met any of you, and Tineke, I haven't met any of you either today or earlier. So if you have any feedback on this plan, if you have ideas for finance institutions that may be interested in this, or if you have ideas for collaboration, then I'd be very interested to hear about that. Thanks.